Well, in all different areas. If you go to different areas of the country, it's just big time. And the real estate values keep going up. And by the way, the other side of this, I want to talk about the rental side in a second. If the value of the real estate keeps going up and housing keeps getting more expensive, does that mean rents will also go up? Yes. Will rents double? What do you think? Triple. In fact, in 1960, and I don't know, I didn't pull up the statistics, but I'm willing to bet you that rents for a single family house in 1960 was a couple $100 a month. I'm telling you, if we would look, what are rents now for a single family house? $1,200 to $1,500 a month, depending on the house. So has that also went up, if you think about it, about 10 times. Not as fast as the housing itself, but it's still duplicated quite a bit. See what I'm getting at? All right. Kind of went off on a tangent. I do that once in a while. Let's go now back to your notes, okay? Number 4. Top of the next page. Points. Not going to spend a whole lot of time on this other than to tell you this. What's a point? What is it? 1% on the loan amount. What's the purpose of points? To lower the interest rate during the loan by paying interest up front. That's really what points are. Now, think about this a second. Are more and more sellers going to be paying points in the future if the real estate market stays soft? Why? It's to get buyers to be able to afford to buy. So therefore, sellers are going to start paying points so they can lower the interest rate for those buyers so those buyers can afford more loan to buy their house. Does that make sense? Now, if the seller pays points or if the buyer pays points, it does not make any difference. They are tax deductible to the buyer if they're buying it for a primary home. And that's what it says under point 4. It's already printed in your notes. That the points are deductible by the buyer in both cases, whether the seller or the buyer pays. And then finally, the last issue on the bottom there talks about taxes. Property taxes are deductible. They're deductible by whoever owned the property during that period of time. And the example to give you there is if there's a closing in the middle of the year, let's say July 1st. Seller lived there for 6 months. They deduct their 6 months of taxes they paid on their income tax. The buyer would deduct their 6 months on their income tax. All right. Then the next thing in your notes it says is tax when selling your home, and you have a little chart there. Everybody see that chart? I want you to skip the chart and go to the top of the next page. Skip the chart in your notes and go to the top of the next page. And then when you get to the top of the next page, I want you to put your pencils and pens down for 10 minutes. Now, since I'm making you put your pencils and pens down, what do you think that means?
Right.
You don't have to take any notes. I just want you to listen, because here's what I'm going to do. The chart I just had you skip, I'm going to teach it to you, but I'm going to use the whiteboard up here instead. Because what I want to do is take you back to something you should have already learned in Course 1. In fact, I know you did because you need to know it for the exam. You learned something about when somebody lives in a primary home and they sell it. You learned as long as they occupy the home for at least 2 out of the last 5 years and they sell, they don't have to pay any tax on their gain on that property if they're married up to $500,000, if they're single up to $250,000. Great. You learned that for the exam, but you did not learn how we got there and all the details to it. We left a couple things out. So now I'm going to teach you the details. To do that, I'm going to take you back into time. To take you back into time, I'm going to go back about, let's say 30, 40 years ago. And I'm going to say 40 years ago we went out and we bought our first house. And when we bought it, we paid $20,000 for it. Now, when I say we paid $20,000 for it, that's not the price. We paid $15,000 price, but then as we owned the property, we put on a deck, we put on a roof, we did some improvements. So we have $20,000 into it. Does that make sense? Now, we're going to keep the property for 10 years and then we're going to decide to sell. When we sell the property, we're going to sell it for $40,000. And that's what we get after we pay commissions, fees, etc. So we might have sold it for $45,000, but we had to pay out fees and so forth to sell the property. We netted $40,000. So, real simple question. If I bought it for $20,000, sold it for $40,000, I made an obvious profit of how much? $20,000. Now, here's the issue. I took you back about 40 years ago. Well, 40 years ago, if I made a profit on a piece of real estate that I lived in, that $20,000 profit was taxable. And I now owe tax on that $20,000. However, they had a rule at the time that said this. If when you sell your $40,000 house, you go out and buy another property to replace it within 2 years of the sale for the $40,000 value or greater, then you will not have to pay tax on that $20,000 today. Now, think about what I just said. What did the government want you to do? Sell it, go buy another property within 2 years for $40,000 or greater. What do they want you to do? Buy bigger. Why do they want you to buy bigger?
More stuff.
Yeah, if you buy more bigger, you got a bigger house, you got more space, then you'll buy more stuff. You see how they were encouraging this? So what did most people do? They did exactly what the law said. They said, we're going to sell this, we're going to go buy another property, we're going to buy one for $50,000. We're going to live in that property for approximately 10 years. We're going to sell it for 100. Well, if we bought it for 50, sold it for 100, we're now going to make a profit on this property of $50,000. And when we sell this house, we now owe tax on how much? 70. See, here's what people didn't understand. Because you bought another house, you did not have to pay tax on that 20 today. But the 20 did not go away. The government says we're going to take that 20 and we're going to remember it. And we're going to add it to your profit on your next house. So now that you sold this one, you now owe tax on 50 plus the prior 20 for a total of 70. And you owe us that tax in the year of that sale unless you go out and do what? Buy another one for how much? 100 or greater. Whatever you sold it for or greater. So now I'm going to go buy another one. I'm going to buy one for $200,000. Move it up. I'm going to live there for 10 years and I'm going to sell it for $400,000. I'm going to make a profit on this property of $200,000. And when I sell this, I know tax on how much? 270. Oh, by the way, who's keeping track of all this? You are. Verse is not. It goes back to something I said earlier. You can do anything you want on your tax return. And you never ever have to worry about it because we live in a country where we are on the honor system. So you never have to worry about it. Do whatever you want on your tax return. Don't worry about it unless you are audited. And then when you're audited, the IRS expects you to know every single tax law that pertains to your tax return. And if you don't, it's okay. They'll help you. Therefore, who's supposed to keep track of this, gang? You are. What if you didn't know it?
Too bad.
Too bad. If you're audited and you don't know it, are you supposed to know it? Yes. So now watch this. We now have, if you kind of add this all up, this is anywhere from 30 to 40 years. And now I'm going to sell, I'm going to add this all up. I now have $270,000 worth of gain that I have to pay tax on. Well, now let's just think logically. Most people buy their first house when they're in their 20s to 30s. Would you agree? Their age 20 to 30s. Add 30 years to that. That means we're selling this house now, probably in our 60s. Well, when most people sell their house in their 60s, tell me what they're doing. They're downsizing. They're not moving bigger. Well, if you don't buy a house of equal or greater value, guess what time it is? It's tax time. And now you have to pay tax on the $270,000. Now, what I'm about to teach you is all the laws before this date. May 6, 1997. And I'm bringing it before that date for a reason. And I'll explain it in a second. But if you sold this property before that date, you now owe tax of $270,000. The current tax bracket you were in at that time was 35%, which meant of that $270,000, you owed about $90,000 in tax when you sold that house. Now, would you agree that people that were in their 60s or 70s did not understand this? So they sold the house and then they got a surprise of a $90,000 tax bill. Would you agree that could ruin a lot of their financial plans? In fact, could have wiped out a lot of people's nest eggs. So therefore, the government said, you know what? We don't want to hurt our senior citizens, so we're going to add something to the law. We're going to create an exception that goes like this. If when you sell the house, you or your spouse are over the age of 55, either one. If you're over the age of 55, we're going to give you a once-in-a-lifetime exclusion of $125,000 that you do not have to pay tax on. Therefore, in this example, you will pay tax on the balance of $145,000 at 35%, which means your tax bill is only $50,000 versus $90,000. But you had to be over the age of 55 when you sold this. All right, now, what I just taught you is all the laws before May 6, 1997. So here we are in 2007. Why am I teaching you this? Because I need you to clearly understand on that date, they changed almost everything.